So, what was going on with SoFi's stock today? It was a total roller coaster. And here's the kicker. There was pretty much zero official news from the company. So what was really pulling the strings behind the scenes? Well, today we're going to play detective. We're going to piece together all the clues, from a shocking economic report to a last-minute plot twist, and solve this little mystery together.
So yeah, this is the big question, right? The stock's movement today was anything but simple. Was it some bombshell economic data that rocked the entire market? Or maybe a confusing move from a company insider? Or was it something else, something kind of hidden in the trading data itself? It was a genuine puzzle, and we're about to unpack it.
And here's where we landed after all that drama, down less than 0.5%. But the really interesting number isn't even on the screen. The stock traded on just 22 million shares. Now its average is over 60 million. That's what we call super low volume, and it usually means there's a real lack of conviction, like a tense tug of war where neither the buyers nor the sellers can get the upper hand. That's our very first clue that something weird was going on.
Okay, so the first major piece of the puzzle, it actually had nothing to do with SoFi itself. Nope, it came from the wider economy. And it was a perfect example of that bizarre market logic where amazing news is somehow treated as a terrible, awful thing.
Whoa, just look at the gap between these numbers. Before the market even opened its doors, we got the latest GDP data. Now, Wall Street was expecting a pretty solid 3.2% growth, but the actual number, it came in at a blistering 4.3%. The economy wasn't just doing well, it was on fire. And frankly, the market was just not ready for that.
So why on earth would a booming economy completely spook investors? Well, it all comes down to one thing: the Federal Reserve. You see, for months, the market has been counting on the Fed to start cutting interest rates. But when the economy looks this hot, it gives the Fed a really good reason to keep rates high to make sure inflation doesn't get out of control. So in the blink of an eye, that fantastic economic news just kind of vaporized the market's hope for a rate cut.
And look, you can see exactly what that did to the market's thinking right here. Just yesterday, traders saw about a 20% chance of a rate cut. Then that GDP report hits, and bam, those odds just collapsed to a little over 13%. That sudden shift sent this wave of anxiety rippling across the whole market, and it dragged down growth-sensitive stocks, just like SoFi.
Okay, so just as the market was trying to process that big macro shock, a new alert started flashing across traders' screens. And this time it was coming from inside SoFi's own house. And folks, this is where the story gets really interesting.
This quote right here, it perfectly captures that immediate gut reaction everyone had. A filing showed that SoFi's chief technology officer, a guy named Jeremy, was selling stock. And the key detail was that the transaction was coded as a direct S for sell, not a routine sale to cover taxes. To an investor, that kind of thing can look like a huge red flag.
And we are not talking about a couple of shares here. The filing showed he sold 91,000 shares. I mean, when a top executive sells a chunk that big, the immediate fear is always the same. They must know something bad that we don't. But that wasn't the whole story.
To really get what's going on, you have to understand this one key term: a 10b5-1 trading plan. Basically, it's a way for company insiders to schedule their stock sales way in advance. This protects them from being accused of trading on secret information. The big takeaway here is that the decision to sell wasn't made today, it was probably made months ago.
So this context, it changes everything. This wasn't some panic sell because of today's bad news. It was a pre-scheduled transaction that just so happened to land on a really weird day. It's also super important to remember that executives sell stock for all kinds of personal reasons that have nothing to do with the company's health. Diversifying their own money, or maybe managing finances through a big life event like a divorce.
Okay, so we've got a nervous market on one hand and a confusing insider sale on the other. But what were traders actually doing with their money? Let's pull back the curtain and decode their playbook by looking at some hard data. The options market is a great way to take the temperature of trader sentiment. And today? Man, it was basically split right down the middle. 48% of the action was bearish. That's people betting the stock is going to fall. Meanwhile, 52% was bullish, betting it'll rise or just neutral. The bears were definitely out in force this morning, reacting to all that negative macro news.
But here is where the story takes a really fascinating turn. So while some traders were making bearish bets in the options market, the short sellers, they were doing the exact opposite. Just look at this last row. Over 163,000 shorted shares were returned today. Now remember, short sellers make money when a stock goes down.
So returning shares means they're closing out their bets. That's a bullish sign and a total contradiction to all the fear we saw earlier.
So what gives? Why the disconnect? And why was the stock just kind of stuck in the mud? Well, a lot of traders are pointing a finger at the invisible hand of algorithmic trading. These are basically automated computer programs that buy and sell based on keywords and data points. And they can totally amplify fear from something like a GDP report and help keep a price down, all without any of the human nuance.
So the day is just this chaotic mess, right? You've got market-wide fear, confusing insider news, and deeply conflicted trading data. The stock was just struggling to find any direction at all. But the trading day wasn't over yet. And in the final hour, the entire script got flipped by one last, totally unexpected twist.
I mean, it really looked like SoFi was just going to limp to the closing bell with a loss. But then, with less than 60 minutes left on the clock, a brand new piece of information hit the wire that completely changed the momentum of the day.
And this was it. An analyst at a firm called NAM dropped an absolute bombshell of a rating on SoFi. Their new price target? A jaw-dropping $36. I mean, think about it. At a time when the stock is trading around $7, this wasn't just some positive little note. This was a massive vote of confidence that landed like a lightning bolt right at the end of the session.
This sudden shot of pure optimism was exactly what the stock needed. It gave buyers a powerful, concrete reason to jump back in, and that energy just overpowered all the negativity from earlier in the day. It fueled a rally that erased most of the losses. It was the positive catalyst that finally broke the stalemate.
So let's put it all together. What was really driving the chaos today? You had 4 different forces all clashing at once. First, it started with that strong GDP data creating a headwind for the whole market. Then, that pre-planned insider sale got misinterpreted and added to the fear. Underneath it all, the traders were completely divided. And then finally, that surprise analyst upgrade swooped in at the last minute to save the day.
You know, this one single day is a perfect snapshot of the modern market. A stock's price is almost never about just one thing. It's this constant battle between huge economic forces, company-specific stories, and the wild psychology of millions of traders. Which, of course, leaves us with the ultimate question, with so many conflicting forces pushing and pulling on this stock, which one is actually going to win out tomorrow? Well, that's the puzzle every investor is trying to solve.